Hello and welcome to the BNP Paribas Asset Management Talking Heads podcast. Every week, Talking Heads will bring you in-depth insights and analysis on the topics that really matter to investors. In this episode, we'll be discussing AI. I'm Daniel Morris, Chief Market Strategist, and I'm joined today by Derek Glynn, Associate Portfolio Manager on our Disruptive Technology Strategy. Welcome, Derek, and thanks for joining me.
Hi, Daniel. Thanks for having me. Glad to be here.
Derek, it feels like if we're not talking about politics these days, we're talking about AI. Investors are quite aware of the significant returns in the NASDAQ this year. More recently, we've fallen back, but we want to put that into perspective. Just back to the levels we were at the end of June, which was already up 18% for the year. So I think investors will be pretty happy with those gains. What's been driving that has been enthusiasm around the potential for AI to impact corporate profits, the economy more broadly, and inevitably the discussion whether that enthusiasm is warranted or not. Everyone thinks back to what happened in the late 90s and early 2000s, and certainly no one wants to see a repeat of that. So what's happening with AI and where do you see that potential? Let's start with generative AI and maybe distinguish what is different about generative AI as opposed to AI more broadly, and how generative AI could usher in a new wave of innovation in the economy.
Generative AI is a technology that can generate content from a text-based prompt. Technically, these are large language models designed to mimic the way humans think. They're trained on a vast amount of data and were originally designed to predict the next word in a sequence. But with more and more data and the right type of training, they've been able to reach advanced levels of reasoning. My conviction in the potential of the technology to result in more economic innovation and productivity has grown over time. The technology itself has improved rapidly. Not only do the answers appear to be more accurate and relevant due to new training techniques, but the way in which we interact with the models has improved. State-of-the-art models today can now incorporate images, audio, and soon video. It's a much richer experience and a better interface for the user. It feels more natural when communicating with the model. These formats also unlock new uses. For instance, language translation, say from English to French and vice versa, is close to seamless using the model as the translator and intermediary. We also have many early proof points that suggest there are productivity benefits for the economy. Developers, for example, can use generative AI tools to help them write code so that part of the code is automatically generated by AI. Another important innovation is the amount of data that can be ingested by the models. The best models now have the capacity to reason over the equivalent of 10 to 20 novels. This also helps developers and others with long-form uses. Software is growing as a share of total GDP, so productivity improvements in this area tend to have an outsized impact on the economy more broadly. From an enterprise adoption perspective, we're seeing more and more companies become interested in evaluating the technology, even in heavily regulated industries that have sensitive data, like financial services and healthcare. We're seeing companies move with a sense of urgency to adopt AI solutions.
We see the major cloud service providers planning to accelerate their spending to support their AI efforts, building out data centers. What are the implications of this spending? And more importantly, do you think they can earn a good return on their capital?
We think there's an AI arms race developing between the mega cap technology companies that are investing in generative AI. We estimate the major cloud service providers in the US could spend over $150 billion combined this year. If we were to also include a couple other mega cap technology companies that are building out AI infrastructure, that number could eclipse $200 billion. That's a big number and would represent more than 50% year-over-year growth. As you alluded to, a key topic of debate in the financial markets is whether these companies can earn a good return on their CapEx. Some investors worry that this trajectory could result in a lot of wasted spend. Many pessimists tend to draw analogies to the dot-com era of the late 90s and early 2000s, a boom and bust period when companies overbuilt global networks of fiber optic cables and eventually faced financial difficulties. I don't think that's a good analogy to what we're seeing today. And I think it's unlikely that something similar would play out for the major cloud service providers. There are some important differences. First, many of the mega cap tech stocks of today already have strong core businesses and various means to fund their capital expenditures without necessarily incurring a lot of debt. These core businesses tend to generate high amounts of free cash flow, and they're often supported by numerous competitive advantages like network effects or economies of scale. So we believe their ability to generate cash is durable. They also tend to have strong balance sheets with large amounts of cash. So they have various avenues of funding these initiatives in low cost of capital ways. As it relates to the return on capital specifically, I think they'll be good, but there will likely be variation across the cloud service providers. They should all benefit from activities in the cloud like storage, computing resources, and renting out access to graphics processing units for use in AI applications. However, the best positioned will be those that can use generative AI to develop a new product or service that can be monetized. The highest returns will be generated by those that can expand beyond the infrastructure layer and develop AI-enabled applications that become widely adopted.
We've been talking about the cloud service providers. What industries, what types of companies, Derek, do you see as well positioned to benefit from generative AI? Who do you think will be the winners and the losers?
There are many industries that are benefiting from these high levels of spend and from the technology itself. For instance, the early winners include many of the semiconductor and semiconductor equipment companies. They are fundamentally enabling this technology. We also think there will be opportunities for companies in non-technology sectors that could benefit from the build out of data centers. For instance, industrials companies that provide cooling solutions could benefit, as could alternative energy companies like solar, because many of the cloud service providers have net zero commitments that they need to meet. Cybersecurity companies could also stand to benefit. Bad actors could access these powerful new AI tools, and it's essentially a new threat vector that needs to be protected. An interesting area here is in machine identity and authentication. AI models will increasingly act autonomously and interact with each other. Those machines need to be authenticated so that the right models are talking to each other and are protected. We also believe those with proprietary data, more generally, are well positioned because they can integrate generative AI to develop new products that can be monetized or to improve retention rates with existing customers. In terms of risks, we're wary of companies that could get disrupted or disintermediated, particularly if they don't adapt quick enough. Some software businesses could face more competition, particularly if they don't have proprietary data or other barriers to entry. In other cases, for some industries like e-commerce, AI features will essentially be commoditized. These features won't necessarily help companies differentiate themselves from the competition. They'll just be common features of the product or service. It's only a matter of time before every major e-commerce site has an AI-powered copilot that assists consumers with their shopping and helps them find the right items and answer questions about those items. But those features won't necessarily be monetizable over and above their existing businesses.
What about the future? We appreciate how rapid the advancements have been around AI over the last year, even if it's been many years in the making. What can we expect to see over the next few years?
We'll see continued refinement in the ways we interact with these models. There's still progress to be made in the audio and video formats, for example. Another trend will be much broader enterprise adoption, likely to occur in 2025 and beyond. Although companies are evaluating and beginning to adopt it today, it just takes time to get their data estates in order and to get comfortable with security, governance, compliance, and privacy standards of generative AI. In time, I would expect to see improvement in categories that require very advanced levels of reasoning, such as some higher levels of mathematics, and in long-term planning generally. The latter could be an important unlock for one day attaining artificial general intelligence, or AGI, which is loosely defined as an AI model that has attained or surpassed human levels of reasoning. Finally, I would expect greater clarity in terms of regulations around AI and a continued focus on the risks. There is still more work to be done on potential issues like copyright, data security and privacy, misinformation, and AI safety more broadly.
Normally at this point in the podcast, Eric, I do a summary of what you shared. And honestly, if I'd been better prepared, we would have had an AI prepared summary of this, though I'm a bit worried it would do a better job than I would do, and suddenly I'd be out of a job. So I'm going to do my best. Some of the key points that you shared with us, already we're seeing productivity gains for the economy from generative AI. Of course, we anticipate many more gains in the future, particularly when companies are spending this year anywhere from 150 to 200 billion in CapEx, and that is 50% higher already than we saw last year. At the same time, when we talked about the concerns, you said that the parallels that some people see to the dot-com bubble at the end of the 90s, early 2000s are not warranted. Finally, when we talked about the future winners beyond the semiconductor companies that are clearly gaining today, you pointed to potential for industrial companies, alternative energy, and cybersecurity. Well, Derek, thank you very much for joining me.
Thanks, Daniel. Glad to be here.
That's it for this week's episode of Talking Heads. If you would like more information, please reach out to your BNP Paribas Asset Management contact or check out Viewpoint, our website for investment insights at viewpoint.bnpparibas-am.com. Just before we go, I'd like to mention that the Talking Heads podcast is available on YouTube. Visit youtube.com/bnpam/playlist and tap or click on Talking Heads. You've been listening to the BNP Paribas Asset Management Talking Heads podcast with me, Daniel Morris, and Derek Lin. Please do join me next week. Until then, take care.
This presentation includes a discussion on current market events and is not intended as investment advice or an offer of products or services by BNP Paribas Asset Management. Please keep in mind that the information and analysis in this presentation is only current as of the publication date.